It's time for Yahoo Finance's Market Minute. Stocks are mixed after that February CPI print and retaliatory tariff news from Canada. Nvidia attempting a rebound here, up about 5%, boosting the Nasdaq on that back of a better than expected February CPI print. A few analysts this morning, including Wedbush's Dan Ives, saying Nvidia and other Mag 7 names are at attractive entry points given those recent declines. In other chip news, Intel getting a boost on a Reuters report that Taiwan Semiconductor reached out to Nvidia, AMD, Broadcom, and Qualcomm about a deal for Intel's foundry business. And Supermicro Computer extending gains after closing Tuesday as the top performing stock in the S&P 500. Rosenblatt Securities reinitiated coverage on that stock on Monday with a buy rating and a $60 price target. That's your Yahoo Finance Market Minute. For more on what's trending on Yahoo Finance, scan the QR code below to track the best and worst performing stocks of the session.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we're talking about the latest inflation print and what it says about the prices that you're paying for everyday goods. And the recent market downturn could actually be an opportunity for investors, according to one expert I'll talk to. Plus, it's tax week on Wealth, ahead of the April 15th tax deadline. We'll discuss how to fix a tax mistake before it costs you. We've got all that and much more coming up during today's show. But first, we're taking a look at the categories that saw some of the biggest price increases and decreases in February. Overall, inflation cooling in February, headline and core readings both slowing on a monthly and annual basis. Consumers saw relief in grocery prices. Food at home was flat versus the 0.5% increase that we saw during the month of January. In your grocery basket, milk and fruits and veggies are a bright spot. Milk prices down 0.6% during the month. Fresh fruit and veggie prices also down 0.7%. We are seeing an uptick in other categories, though. Bread prices rose 0.4% after a deceleration in January. Meat prices ticked up 0.1% from January. Meanwhile, egg prices still slamming your grocery bill, as the index for egg prices rose a whopping 59% versus last year. Right now, average egg prices in the U.S. cities are at an all-time high, according to the St. Louis Fed, costing you $5.90 for a dozen large grade A eggs. Keep in mind, that same price was around $3 last year. Eating out at restaurants, that got a little bit more expensive last month. Prices there rising 0.4% versus the 0.2% gain during January. Consumers are seeing some relief, though, at the pump. Gas prices down 1% in February and down 3% on an annual basis. And jet setters rejoice. Airline fares falling 4% in February from January. That's just in time for some of the spring break or summer travel planning. And a couple sticking points here. Motor vehicle insurance prices rising 0.3% in February. That's a decline from the month prior, but on an annual basis, those prices are up 11%. And we are still seeing some stubborn shelter costs here, with rent of primary residence and owner's equivalent rent both rising 0.3%, with both of those up over 4% on an annual basis. So overall, inflation softened last month, but there are remaining some key areas that are straining wallets across the country. Let's take a look at some of the market action here. We are 90 minutes into the trading day. Stocks giving up earlier gains following the latest read on inflation. February CPI print coming in lighter than expected, easing concerns about the health of the economy. Joining me now, we've got David Stryzewski, who is the Sound Planning Group CEO. Great to have you here with us. You say that a recession is likely in the near term. So how should investors be navigating this?
Well, a couple things to just understand. The United States has about $7 trillion in debt that's maturing here in the first 6 months of 2025. So that's a big factor that we've got to be, putting into our perspective before we're making that decision. So I think that President Trump and the team right now is looking at refinancing this debt at the much lower long-term rates that we have today, but getting driving them lower here in the future. So his playbook is probably to allow the stock market to crash right now, which pumps the bond market because everyone goes in to buy. This then reduces the yields on that long-dated debt as $7 trillion comes due, then rolling over for a longer duration at this lower amount. So as the market shifts from a risk on to a risk off time frame, I think it's important to understand that a move like this would then potentially cause the Fed to drop rates, which then gets the economy really moving in some different ways. But with that being said, there's a lot of uncertainty today given the liquidity of the tariffs and kind of the back and forth on things. So where do people go? It is an important question. I think ultimately you have to have your anchors in place. And my concern is that the bond market isn't going to be able to, as a whole, keep people in the same way that it has in the past.
You know, you say it so simply, as if just allowing it to crash means that we could instantly have some type of recovery. That recovery could be one that takes months, years even. And as we think about to previous crashes that we've seen, that means a lot of longstanding implications for how people are able to get back into jobs, how their wages in those jobs are able to outlast any forms of economic shocks that they're incurring. So all of these things considered, you've got pretty much every generation that will feel a different impact at a different part of their own purchasing cycle or family formation. So all of those things considered, how do you then plan for a portfolio that outlasts any of those major shocks?
Well, if you're nearing or entering retirement, this is the question. Because sequence of return risk is extremely high right now. What's that? It's within the last 5 to 10 years of your working career, the first 5 to 10 years of retirement. If you have a major downturn, a setback like that, or call it a financial injury like that, it could literally change the course of your retirement. So what you have to do is you have to have your anchors in place. And so here's an idea that is a little bit unconventional potentially, but hear me out because the math and science bears true. So there's 5 different ways that bonds can both make and lose money. And right now, those are kind of all on the table. I'm concerned that we go into a higher interest or higher inflationary environment in the future. We call it tarifflation, if you will, because there's certainly parts of our economy that the Fed cannot affect, like our eggs prices that you just noted, 59% increase over the last 12 months. That's a big deal. But the point is that as we're moving forward right now in this tariff conversation, what do? I think that people should be looking at bond alternatives. Personal one that I like right now is a growth-oriented fixed index annuity. This is a hedging strategy that gives you the ability to have none of the downside of a market, but reasonable rates of return on the upside. It links to an index like the S&P 500. And so this gives us an easy way on an annualized basis to have a reset, because if the market falls apart, guess what? Zero's my hero. I can allocate back in. I've got dry powder. This gives a baby boomer or somebody nearing or entering retirement the ability to dollar cost average while also potentially staying ahead of inflation because of that the index linking component to it. And so these have been working out exceptional, but ultimately I think there's never been a better time to actually own one than the present moment that we're in right now.
You're also looking across some of the precious metals or miners. Why is that?
Okay, so precious metals are so there's 2 different ways to play metals here. We got precious and we got miners. I think the precious metals, just watch the numbers right now. Looks like gold is going to be achieving the 3,000 marker here, within the next week or so. But watch silver as it is literally at about a 35% discount to its all-time high of $50. And I think that it's moving. The Trump administration has actually brought back 2,000 tons of gold to the United States here since December. That's something that's out there. You just have to do the research to understand it. But just know this as well. We're also doing an audit on Fort Knox here in the month of March. And so if there's an audit on Fort Knox, it's either going to be good for the United States that it's all there, or maybe not as good. I'm not really sure. But the point is that there's a revaluation that's going on. Bankers don't do anything unless it's in their best interest. And right now they're allocating and bringing back some gold. So I think this is an important way to play it. One of the ways to do that is with the miners. And so miners have been beaten up for decades. And ultimately, I think they're going to be the sector that will lead our economy in the next 3, 5, and even 10 years as we're doing more drilling and we need more strategic minerals because as the price of these things go up, the need for some of this stuff continues to move forward. That is going to become key worldwide for electrifying AI, data centers. It all needs materials, and so we've got to get them somehow.
All right, David, thanks for taking the time here with us today.
Pleasure.
Coming up, everyone, we're taking a look at the latest housing data, from the change in prices over the past month to the best time to put your home on the market. That's next on Wealth. Shelter inflation showing signs of easing in the February CPI report. Our very own Danny Romero going to break down the numbers for us. Danny.
Brad, shelter remains on the disinflationary path. So let's take a look at these numbers. The government data showed that shelter costs rose 4.2% on an annual basis. That is the slowest pace in over 3 years. Now, on a monthly basis, housing costs ticked up by 0.3% last month. Now, it's very important to note that the housing component accounted for nearly half of February's overall monthly increase. Remember, there are two components that economists pay very, very close attention to and hold the biggest weight in the shelter figure. That's owner's equivalent rent, OER. That's the hypothetical rent you would earn if you were a homeowner renting out your property. OER came in at 0.3% gain last month, and rent, which lags real-time data because the government collects rent data every 6 months, which causes a lag in the index. Rents rose 0.3% in February. Now, looking ahead, some economists believe that rent growth will move lower this year, pressured by stricter immigration rules and tariffs impacting construction. Brad?
Danny, thanks so much for breaking this down for us. Appreciate it. As we head into the spring home buying season, February shelter costs were 4.2% higher than the same time a year ago, the smallest 12-month increase since December of 2021. Joel Berner, Realtor.com senior economist, joins me now to talk more about housing. Joel, good to have you here with us on the show. Just want to get your takeaway from this latest consumer price index print and the shelter component.
Yeah, just like we heard, this number tends to lag. It's a survey of actual renters who are reporting how much they're paying. And so a lot of people we're seeing stay in their homes for longer than they have in previous years in this high mortgage rate environment. Lots of would-be first-time home buyers are remaining renters for longer. And we're seeing those same home rents increase at a pace that's a lot faster than what we're seeing on the market. I'm working on right now our monthly rental report, and what's going to show that for the last 19 months, the market asking rent has actually been falling on a year-over-year basis. So this CPI readout is really just catching up to the realities of the market with what can be charged for rent right now.
And so with all of this in mind, as you're thinking about the costs that we're looking at for shelter, what are we seeing in terms of just home prices easing? Because this has been increasingly important to address the affordability crisis right now.
Yeah, price per square foot growth has really slowed down, but remains positive. What's falling right now is the median listing price, but that's more of a result of smaller homes hitting the market. So we are seeing a lot of price reductions on the market right now. In February, that reached the highest level it's been in a February since 2017. So a lot of sellers on the market are having to make adjustments to get their homes sold.
Realtor.com found that the best time to sell a home this year is the week of April 13th through April 19th. Why is that, Joel?
Well, that's a combination of several factors. So at that time of the year, prices are relatively high. There's relatively less competition from other sellers and relatively more views on homes from home shoppers than there are at other times of the year. This week of April 13th is kind of the perfect mix of those three criteria in an opportunity to sell your home at a good price when lots of people are looking and before the big surge of new homes hitting the market. So we find that historically, this kind of middle April time period is the best time to list your home.
Okay, so what does that mean for buyers? Should they also be planning for early spring purchases or making sure that they've checked their list and running through all of the properties that are out there that have caught their attention?
Well, right now in 2025, the spring is a good time for buyers. We're seeing some really buyer-friendly conditions on the market. Time on market has increased, the number of price reductions has increased, and inventory is up. So right now is a good spring for buyers, but generally, looking at historical trends, the best time to buy a home is in the fall. Just for the opposite reasons, as spring is the best time to sell a home, fall is the best time to buy a home. There's less competition from other shoppers. There are more homes on the market that have been sitting all summer and haven't sold yet, and price reductions are at a higher point than they usually are. So it's kind of a flip-flop perspective, but I will say that for 2025, it's shaping up to be a strong buying season.
What are your expectations and outlook on mortgage rates? What is the sweet spot?
Today's inflation news was really helpful. We think that that's going to give a little bit of space for mortgage rates to come down. The big fear has always been tempering inflation with how we've kept mortgage rates high and seen them kind of creep up in the last couple months. Though in the last few weeks, we've seen some relief as the 10-year Treasury yield has softened. So we expect to see mortgage rates come down just a little bit in the coming weeks, but we don't expect to see major relief, like getting into the kind of 3%, 4% range that we saw a few years ago. We're kind of expecting to end the year in the low sixes, I should say.
So is policy-related uncertainty impacting the housing market? How are buyers and sellers both kind of going about their own expectations on policy?
Uncertainty is really what's the name of the game right now. So buyers are looking around and, some of them have lost jobs. Some of them are seeing their businesses struggle due to the trade war currently going on and feeling a little reluctant to maybe jump in. And for sellers, the same is true too. Mortgage rates are remaining uncertain and remaining an unclear path as to how fast the market will be moving and how fast they'll be able to sell homes. And a third party that has a lot of stake in policy is builders. Builders are looking around and saying, my inputs are going to increase in cost because they're coming from other countries. And so we saw in the most recent new construction data a pickup in completions and a slowdown in starts. So what that means is builders are really trying to get their projects finished and are a little reluctant to start new ones because of the uncertainty they see in the market going forward.
Is that uncertainty tied to tariffs, or is there something else? As we've talked with one economist earlier today about immigration, or reverse immigration actually impacting some of the labor inputs as well.
It's both, yeah. Tariffs are a major part of it. The cost of construction inputs are going to be a burden for builders to get over. But also, we know that about a third of the construction labor force is born outside of the United States. So there's going to be a pinch on the people who are actually building these new homes. And it's going to be a little bit more difficult for builders to train and pay their employees than it was a few years ago.
Joel, thank you so much for taking the time here today, breaking all things housing, shelter down with us. Appreciate it.
Thank you for having me.
Canada announcing new 25% counter tariffs on about $21 billion worth of U.S.-made products. This comes after President Trump went ahead with 25% tariffs on all steel and aluminum imports. Canada's new levies go into effect at 12:01 a.m. Eastern Time on Thursday and affect steel, aluminum, and other U.S.-made products. We want to dive into the impact those tariffs have and they might have on U.S. consumers, and speaking specifically what it means for the U.S. autos industry. Here with more, we've got Greg Migliori, who is the editorial director at Auto Guide. Greg, great to get your insights and great to grab some time with you as always here. So what is perhaps the broad scale read here on the impact of tariffs, especially on these aluminum and steel tariffs that have been put forward between the U.S. and Canada, how that dovetails through to vehicles?
Sure. Well, thank you for having me, Brad. And I think aluminum and steel are, they're two fundamental parts of the car itself. They're structural. There's no way of getting around it. So by adding tariffs, they're simply going to raise the cost of vehicles and the cost it takes to make these vehicles, which will likely be passed along to consumers. So it's a major disruption for the automotive market, for consumers, for the automakers who are trying to figure out how they can price their vehicles competitively. And I think it definitely could cause, a pinch in sales for the rest of the year. We'll see. It all depends on if the tariffs actually go into place, if they're pulled back, and what the long-term ramifications of them would be.
What did we see last time? Because this is not our first time within the past 10 years having to run the calculus around what percentage of that cost would get passed on to consumers and how materially the prices would change for vehicles, or even for parts if you're getting your vehicle serviced.
Yeah, so last time was a bit of an outlier because during the first Trump administration, there was a lot of tariff actions and disagreements and all of that. But then what happened is we ran right into COVID, and that completely upended the supply chain. You might remember the chip shortage, which automakers found a way to navigate. And it's a serious disruption. Now, what's I think sort of unique about aluminum and steel in particular is, again, they're a fundamental part of a vehicle. With chips, as important as they are, with software, with different systems that are used, you could actually make vehicles in a different way. You could adjust, you could hold some back. It wasn't ideal, but it was doable. It was adaptable. With these two raw materials, which automakers have been sourcing for over a century, they have their ways of doing it. It's very hard for them to turn on a dime and try to figure out how to adapt to the latest sort of tariff.
And so with that in mind, what should consumers expect as they're trying to ultimately figure out what type of vehicle to buy, what's going to be more cost effective for themselves?
So it's a little bit different than, say, like the EV situation where, obviously the Trump administration is trying to pull back from those and shift the market there. With aluminum and steel, they're so ubiquitous. So there's not one type of vehicle you could say, hey, I'm going to avoid this. There's not too many carbon fiber cars out there that you can affordably swap in for your Ford Explorer or something. So it's going to be, I think the pain will be felt all around. And I think the move right now is if you're in the market, you really want to have your head sort of on a swivel and look for deals, look for any other sort of incentives that automakers or dealers might frankly put on to continue to try to move the metal. Because dealers and automakers, they don't want to start having inventory backup. They don't want a sales slump. So there could be some sort of incentives or things put on more at the manufacturer or the dealership level. If you're in the market, you just want to be extremely vigilant for the next few months and see if that deal that you're looking for is still available and how that impacts your pocketbook.
Greg, always great to get some time with you. Appreciate the breakdown here.
Thank you, Brad.
Coming up, common tax mistakes that could cost you. We've got some tips to help you avoid them and what you can do if you already filed with the mistake. That's next on Wealth. Let's get a check of the markets as we are 2 hours into today's trading activity. This is post the consumer price index prints that we got for the month of February. The Dow Jones Industrial Average was in positive territory to start off the session. Here, we'll light up this chart here just to give you a good view of what's transpired since then, as we have been in negative territory since late in the 9 a.m. hour, just after we began trade here. We were positive, but now negative by about 0.6% during today's trading activity. Also taking a look at the tech-heavy NASDAQ, we've largely held on to gains, but we have seen a little bit of slippage over the course of today. We're well off of these session highs and now holding on to gains of about 0.7%. And for the S&P 500, similar case there. That did dip into negative territory here at the start of the 11 a.m. hour, also touched it at the end of the 10 a.m. hour, we should say. Flat, just barely to the upside, holding up to about 0.1% in gains right now. Let's go under the hood just a little bit further and get you some of the sector activity. We are red across the board right now, the deepest of the decliners right now, and that's a 1 month view, so I want to give you an intraday view. This looks a little bit more accurate. Okay, this is what we've been watching throughout much of today's trading activity, and this is what we saw at the beginning of today's trading session. Consumer staples actually leading some of those declines. That's down 2%. Some of those safe haven plays that were catching a bid earlier on in the week when we did see volatility ratchet higher, and we can take a look at the VIX in a hot second for you folks at home. One of those areas that we had seen a lot of trades flow into was staples, was also healthcare, was also utilities. And so as of right now, we're seeing those leading some of the pullback, and it's technology that's catching a bit of a bid here on the day. That's up by about 1.2%, but you do have more laggards than advancers. As we're taking a look at some of those advancers here on the day, I just wanted to tab on over to the NASDAQ 100 for you just very briefly here and take a look at some of those mega cap tech stocks. NVIDIA, as of right now, you're seeing that higher on the day by about 5%. So a few of those names seeing a little bit of a bounce back. Palantir, they had their social media post that has them moving higher as they've got even more of the developments set to be announced for AIPCon. That's taking place soon, and ultimately Palantir catching a bit of action on the day as well. Okay, I mentioned VIX. I just want to quickly, I know we got to go, I want to quickly come over to that so I'm not lying to you real quick. And we're taking a look at the CBOE Volatility Index, the VIX as it's popularly known. There we're taking a look at, it's sitting at about 26 right now, and we've been at that and above that kind of 25 range here for it seems like the past 5 days. We've just been in that ballpark, so we'll continue to watch that as the fear gauge index is sitting in that ballpark. All right, now time for some of today's trending tickers that we're tracking. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, we got to take a look at shares of Novo Nordisk, off roughly 5% this morning after the fellow European drug maker Roche reached a deal to develop a weight loss drug. As part of the deal, the Swiss drug maker will pay Zealand Pharma $1.6 billion in upfront cash, as well as additional development and sales-based milestone payments worth up to $3.6 billion. This deal expected to close in the second quarter of this year. Shares of Novo Nordisk, creator of weight loss treatments Ozempic and Wegovy, it's down over 13% year to date. Next up, let's take a look at shares of Starbucks, falling hours ahead of its annual shareholder meeting. The company's investors will weigh in on CEO Brian Niccol's $96 million pay package. It also marks the first investor meeting since Kathy Smith took over as the coffee giant's chief financial officer. Shares lower by about 2.4%. Well, it is tax week on wealth, and we have everything that you need to know ahead of the April 15th tax deadline and what you can still do before you file. Today, we're talking about mistakes and how to avoid them on your tax returns. Some of the most common tax mistakes include entering information inaccurately, using the wrong filing status, messing up tax credits and deductions, and simple math errors. According to the IRS, 2.7 million returns had math errors during the 2023 tax season. Joining me now, we've got Adam Brewer, AB tax law tax attorney. So, Adam, we got to know, what are the best ways for taxpayers to avoid these common mistakes?
Yeah, good morning, Brad. The best way to do it is double, triple, quadruple check that return before you hit submit. This isn't a tax year you want to be dealing with the IRS, a lot of back and forth, trying to give them additional information or fix a problem. And so what I'm telling my clients is, make sure you check those portals on your brokerage accounts, your employer email account. Make sure you check your traditional mail. We have all these tax documents that are coming in different ways now. It's not just all in the mailbox. So you really want to make sure that you're picking up all of those documents, reporting all of that income, because you don't want to be, like I said, going back and forth with the IRS trying to get a tax return process this year.
What types of penalties can you face for making a mistake on your tax return?
Yeah, so the most basic one, I think we'd see like a 25% accuracy related penalty. But keep in mind, these aren't mistakes that are often picked up day one. So you're going to pay an accuracy related penalty. You're going to pay a late payment penalty. That's 0.5% per month, up to 25%. And then they're going to charge you interest on top of that. So if this is a mistake that they realize you made a year from now or 2 years from now, it's not unexpected to see that the amount of tax equal the amount of penalties and interest.
So if you already filed with a mistake, what can you do?
Yeah, so if you already filed, if you were proactive, you said, hey, I'm going to do the right thing, get this return in early because I'm worried about staffing cuts or because of the government shutdown potential, or because you want a refund, then you have to file an amended return. And so fortunately, you can now do that electronically. And that's for taxpayers, whether they owe additional money or whether they realize, hey, I overpaid, the IRS owes me money. Either camp can file an amended return electronically.
So how does the process change if you paid too much versus if you paid too little?
Yeah, so the process is more or less the same. It's still going to be an amended return. I'd say it's the urgency side. So if you owe the IRS money, you want to get to that before they realize, hey, this taxpayer didn't report everything. Again, that minimizes the risk of penalty assessment, and that will minimize how much interest you owe them. And so those taxpayers, they want to get that amended return in as quickly as they can. Likewise, if you overpaid, better the money in your pocket than the IRS is. So you also want to get that amended return submitted. I guess there's just not that level of urgency where you realize, hey, every day I procrastinate on this, I'm going to be paying additional penalties and interest.
So what if you owe more money than you can afford to pay when you're filing?
Yeah, so it's really common, especially with all the gig economy income. A lot of these taxpayers now, they're going to have income from sources not subject to withholding. So if you're driving an Uber, driving Lyft, DoorDash, put your house on Airbnb, you're going to end up owing money in a lot of those cases. And so the one thing I tell all my clients is, if you owe, don't let that fear of owing the IRS stop you from submitting the return. Look, this isn't like a soft, cuddly IRS. They're not eager to help you out necessarily, but they do have programs. So you can get on an installment agreement. You can tell them, hey, I need 180 days to pay this balance. And they'll give you that time. They're going to charge you penalties and interest. If it's an amount that's insurmountable, there is an offer and compromise program. There is hardship status. But it really depends on how much you owe and how much time you think it's going to take you to pay it.
Adam, thanks so much for taking the time. Really appreciate it. Some valuable tips
All right,
for those
thank you,
trying
Brad.
to avoid
Have a
those
great
mistakes.
day.
Thanks, you too. The number of Americans expressing confidence around their retirement prospects dropped 7% from last year, according to a new Fidelity study. We want to help address that with those tips for people who are close to or already in retirement. Joining me now on set, we've got the host of Yahoo Finance's Decoding Retirement podcast, Bob Powell. Bob, let's talk about financial planning for your golden years, particularly around taxes, since we've got that April 15th deadline coming up. We're a month and change out from it right now.
Yeah, so a couple things that are worth noting. RMDs are one of the biggest causes of taxes in retirement. And there are some things that you need to know about RMDs. Some background. First, distributions from IRAs and 401ks are required, and those required distributions are different based on your birth year. So it could be 70 and a half, could be 72, 73, 75, a little confusing. But the thing about RMDs is that they're taxable income, and when you take it, it could bump you into a higher tax rate. You could go from 12 to 22, or 22 to 24, or 24 to 32%. So there are some steps you can take to avoid these adverse effects of RMDs. So one is to start thinking about doing full or partial Roth conversion so that you reduce the RMDs when it comes time for you to take these distributions. The other is to start drawing down before you reach RMD age, and that could reduce the RMDs when you get to RMD age. And then the last thing you can do is, if you're 70 and a half and older, you can take something called qualified charitable distributions, or QCDs, which are not taxable, and those are one way that you can at least avoid the adverse effects of RMDs.
Certainly. You know, another consideration here too is your premium management, especially if you have Medicare Part B. What do people need to know about that?
All right, so if you're enrolled in Medicare Part B, you're going to pay a monthly charge. It's called it's roughly on the order of $185 per month, and about 92% of Medicare Part B beneficiaries pay that amount. But if you have what's called a modified adjusted gross income that is above a certain threshold, you may pay anywhere from $259 per month to upwards of $628.80 per month, depending on your modified adjusted gross income, or MAGI, as they like to say. So there are some things that you can do to avoid paying this extra surcharge. One is, if you're doing Roth conversions, you want to be mindful of the effect not only on your taxable income rate, but also on your modified adjusted gross income, because if you push yourself into a higher MAGI, you're going to pay the surcharge. If you're pre-RMD and 63 and older, you also want to be mindful of drawing down your IRAs, because one of the things that taxable income will do will also make your MAGI higher as well. And the last thing you want to be mindful of is this notion of, if you have a severance package or a bonus, or you're selling assets, that income could push you into a higher MAGI as well, and then increase your Medicare Part B premium. One last note about this, Brad, is there's a 2-year look back on Medicare Part B premiums. So in 2025, your Medicare Part B premium is based on your 2023 tax return, and your 2026 premiums will be based on 2 years look back from there, so your 2024.
Oh, wow. Okay, so let's talk about the entire reason why you saved up this nest egg, because you want to draw upon it. How can you best prioritize how to kind of disperse those funds and make sure that the money stretches over time?
Yeah, so one thing I will start by saying is, if you have access to a health savings account and you haven't yet retired, consider contributing it to that, because it's triple tax-free. The money goes in tax-free, it grows tax-free, and withdrawals are tax-free if used for qualified medical expenses. When you're in retirement, you want to think about drawdown strategies. So what's the most tax-efficient way to do that? Take money from your taxable accounts first, then from your tax-deferred accounts, your traditional IRA or traditional 401k, and then from your Roth accounts. And the logic is that this allows the money in your tax-deferred account and your Roth accounts to continue to grow. You also want to consider tax-efficient investments. So if you're in a mutual fund, maybe consider using an ETF. And then if you need tax-free income, municipal bonds are tax-efficient as well. And then the last thing I'd mention is think about account location, where you put the assets, which assets go into which account. So tax-efficient investments go into your taxable account, tax-inefficient investments go into your tax-deferred accounts, and then your high-growth potential investments go into your Roth.
It's a great breakdown. Bob, thanks so much.
Pleasure.
Good to see you. Coming up, everyone, egg prices remain a problem for most Americans' wallets. I'll speak to the CEO of Pete Gerrys next about the outlook for the industry. That's coming up. Egg prices still slamming your grocery bill as the index for eggs rose a whopping 59% from last year in the latest CPI report. Right now, average egg prices in the U.S. cities are at an all-time high, according to the St. Louis Fed, costing you $5.90 for a dozen large grade A eggs. Keep in mind, that same price was around $3 last year. What gives? Here to react to the new data is Tom Flacco, CEO of egg producer Pete Gerrys. Tom, it's good to grab some time with you once again. Just take us into your team's thinking, how you're navigating operations, especially amid what a lot of consumers have come to really realize is impacting these prices, which is the avian flu.
Yeah. Hey, good morning, Brad. Thanks for having me, and good to be with you again. I just want to remind you again that when we think about the egg business, there really are it's broken into two different markets. There's the commodity, which are your caged and cage-free eggs. That's where you're seeing all the inflation. And that's purely driven by supply and demand and pricing tied primarily to Urner Barry, which is an independent index. That index is up. It is up over double versus previous year, and that's what's driving the price of eggs at the shelf to where we see it today. Our model, Pete Gerrys and Nellie's, are free-range, pasture-raised eggs. We're on a distributed network, close to 300 farms in about 15 states across the country. And so we haven't had the same loss of supply, which is essentially hen count, that's driving the price. So our price is the same today as it was a year ago, 18 months ago, going back to 2023 to the retailer. What the commodity folks are dealing with right now is just a dramatic reduction of the number of hens laying eggs today. It's 30 odd million birds have been taken out in the last about 5 weeks, roughly 50 million, which is close to 15% of the population over the course of the last 2 to 2.5 months. All of that ties back to a bird flu strain today that is significantly more contagious than what we've seen in the past. And there are some estimates that the current bird flu is close to 1,000 times more contagious to the birds than previous strains that we've had to deal with, which is why it's not going away. That in turn leads to a real challenge to be able to repopulate those 30 to 50 million birds, depending on what time period you're looking at. You have to lay the eggs. Those chicks have to grow into pullets and then turn into laying hens. That just takes time, and that's what we're trying to catch up with, or I should say but the folks in the commodity end of the business, caged and cage-free, are dealing with today.
That's remarkable in a few things that you mentioned. You said it's not going away. How does that translate through to prices long term?
Yeah, when I say not going away, I mean not going away anytime soon. So the hope is that this is spread by migratory birds. So there is a chance that it starts to reintroduce itself in the migratory patterns in the spring. It tends to then fall away in the summer months. So our hope is that as it starts to abate in terms of intensity, that we don't get the same number of significant hits. And we haven't seen one, touch wood, to a commercial flock in about 3 weeks. So we're hoping that we can turn that into 4 weeks and 5. And that the birds will start to repopulate, but you have to bring that layer supply. Normally, call 330 million hens, about a hen for every person in the country. That number today is about 280 million, 290 million by best estimates. So they have a way to go on the cage and cage-free side to be able to build that population back up. I don't expect it to be fixed anytime soon. If you're asking for any sort of a prediction, it's not something we're going to see go away overnight. It's going to take a little bit of time to build that supply back up.
What are you hearing in the pulse check of wholesale partners or distributors that you work with, or even some of your industry counterparts also work with?
So what we're hearing from retailers are frustrated. Retailers, which is who we deal with mostly. We have some really good distributor partners as well, but we're dealing with both distributors and retailers. They want to be able to offer eggs at a reasonable price to their consumers. Now, the good news is that our eggs, Nellie's and Pete and Gerrys, if we haven't taken price to our retailers, so they can offer that same price to consumers today. So they can offer a value on specialty eggs to the consumer. The challenge is, I was in a store the other day, medium white cage-free eggs were $8.99, and our eggs were on the shelf at $6. Now, unfortunately, our eggs weren't on the shelf. We can't keep up with the demand. We're trying. We're doing our best to bring additional birds on supply. But the problem is, if our eggs are premium and they're $6 a dozen, and you have better hen welfare standards, better product as a result, consumers are going to just default to the premium eggs, which is why they're being sold out so quickly. And what you see in supply are those cage and cage-free eggs. I just want to remind everybody that a cage-free bird is not, in fact, getting outside. They are not sitting in cages, but they are kept inside of a barn. Free-range birds, pasture-raised birds are getting access to the outdoors, which makes our model more expensive, but it also insulates it from some of the problems that you're seeing with that cage and cage-free supply model.
Just lastly, and I only have about 30 seconds, how are we seeing this kind of impact the rest of the shopping basket, if you will?
So for us, we're seeing, again, consumers they're gravitating towards premium eggs. It becomes a more sustainable, more affordable source of protein for their family. They can serve eggs for dinner, eggs for lunch, not just eggs for breakfast. That's how the way consumers are dealing with this very sticky food inflation that we're all experiencing. The other piece is people are not buying cage and cage-free eggs if they can buy the lower and oftentimes lower priced premium offering out there, trying to keep that food bill as manageable as possible.
Tom, it's always a pleasure to catch up with you, and obviously we hope the best for you and your team continuing to navigate what's been very challenging for the industry. Thank you.
Thank you for the time.
Coming up, tips to build your financial confidence in retirement. That's next on Wealth. Members of Generation X, folks born between 1965 and 1980, aren't feeling stellar about retirement. In a new study from Fidelity, only around half of Gen Xers say they feel confident that they'll be able to retire on their own terms, with a third expecting they'll need to work in retirement to keep their finances afloat. Joining me now, we've got Rita Asaf, Vice President of Retirement Offerings at Fidelity Investments. Good to have you back on Yahoo Finance with us, Rita. Just first and foremost, as we think about these numbers that we just rattled off about Gen Xers, why is that they're feeling this way right now, and what's it most prominently tied back to?
Yeah, I mean, Gen X specifically has been the sandwich generation. If you think about that, they're taking care of their children, aging parents, and that is really at the forefront of the confidence drop. So you mentioned over half are confident that they'll be able to retire on their own terms. And this remains a bit of a concern for a number of reasons. One, we're starting to see a record number of Americans expected to reach traditional retirement age. So think of age 65 over the next decade. But on top of that, how you save for retirement has changed. This is probably, the current retirees are probably the last generation to have access to pensions for savings for retirement. And so Gen X really will be the first, we call 401k generation, who'll be using that and other individual retirement accounts such as IRAs as their primary method to draw down from.
So as people are planning for retirement, and we're taking a look at some of the average balances in retirement accounts for 401ks and IRA balances for Gen X right now, how are we seeing Gen X plan for retirement in some of the breakdown of essential costs versus discretionary costs?
Right. So, I mean, this is where having a financial plan definitely helps, especially for that Gen X group that is really coming close to it. So over the last couple of years, they've been saving in various account types and overseeing their investment mix. But at this point, they really should be working more towards how will that retirement plan really be put into action. So think about essential expenses being covered by guaranteed income sources that keep up with inflation. So think Social Security or annuities. And this is what's really important, because if you think about what's happening in the market today, having these guaranteed income sources will help you, whether any sort of investment mix. So that's one. And then secondly, you want to continue to have discretionary expenses covered by savings or investment income. And that way, if there is a market downturn, you can cut back on spending without hurting that day-to-day living expenses that you have.
Rita, you provided us with a hack here, and you mentioned HSA specifically, these health spending accounts. Why is that?
Well, the biggest costs in retirement are healthcare costs. So we in our research have found that an average individual who's retired is going to need about $165,000 for healthcare costs in retirement. And one of the best ways to combat that is not just the planning, but also HSAs. HSAs are one of the most tax efficient vehicles that are out there. The money goes in tax free, the earnings grow tax free, and then they're withdrawn tax free if used on unqualified medical expenses. So they are a very strong tool. However, you do have to be enrolled in an HSA eligible plan to take advantage of that. So it is a feature or factor to be considered as part of your larger healthcare planning in retirement.
All right, the health savings account. Who knew? Rita, you knew. Thanks so much for breaking this down for us.
Thank you.
Appreciate it. Let's do a final check of the markets here as we're taking a look at the major averages. We're still seeing the Dow down by about 0.4%. S&P 500 and the NASDAQ holding on to fractional gains. The NASDAQ close to 1% in gains. We'll see if we can hold on to that as we move towards the back half of today's trading session. But that's it for Wealth, everyone. I'm Brad Smith. Thank you for watching. Stay tuned. Market Domination comes your way 3 p.m. Eastern Time.